Hi, this is Mateus Akawan at Akawan Equity Management. Here we are again for yet another CP study session. Today we're going to talk about restricted stock awards and restricted stock units. As always, before we start, a few quick disclaimers. The contents of this presentation are owned by Akawan Equity Management and are not intended to provide legal, tax, or financial advice. It is essential to bear in mind that this information must not be used as a substitute for professional guidance. This project was created by Akawan Equity Management as a non-profit endeavor, aiming to increase employee ownership, awareness, and support stock plan administrators, participants, and CP applicants. Now, if you haven't watched the sessions on non-qualified stock awards and qualified stock awards, or NSOs and ISOs and Qs, please go and watch them. On these sessions, we are putting some new details, some new content, some new terms on each session to make sure that when you go to the next session, you are able to apprehend the concepts that are being presented. So it's very, very important if you are studying for the CP exam that you do watch all sessions in order. Now, as we go to our third session on restricted stock awards and units, what are those? Now, the main difference between them and options is that they are generally awarded and released at no cost, so the participant doesn't have to pay anything to get one of those. Now, defining restricted stock awards and units. First of all, the restricted stock awards are shares of a company's stock granted to an employee, subject to specific conditions and requirements, such as time-based vesting or performance-based targets. But they are shares. Now, if we talk about the restricted stock units, they are units of stock granted to an employee that have value based on the company's stock price. They are also subject to specific stipulations and requirements. So RSUs, just as options, are not shares at the moment of grant. Restricted stock awards, they are. So let's continue here and talk about the vesting schedule, because we just mentioned performance-based, and these are the types of concepts that we introduce to you on each session, so you will be able to digest them and apprehend all the content that we have planned for the future sessions. Now, time-based is very simple because we talked about this lots of time. A time-based vesting schedule is just like 4 years vesting schedule with options vesting 25% each year, or 4 years vesting with 1 year cliff and options vesting in a 1/48 per month for the subsequent 36 months. We can get a little more complicated or less complicated with the time base, but it is time based. All you have to fulfill is a time based condition to vest your options or units and awards. However, performance based means that we need to fulfill a condition that is based on a goal or a performance. It could be shares being sold at $10 per share in the stock market. It could be the approval of a regulation that is very important for a product that's being developed. Let's say that you work in a pharmaceutical and you are trying to approve a new medication, and the vesting could be based on the approval of that medication when it's ready to go to the market, then you will vest your options. And you could also have a hybrid of that. A hybrid could either be part of the award vesting as a time based and part as a performance based, or you could have something that we call double trigger, which is when for you to vest your award, you will need to fulfill both a time based condition and a performance goal. So it's not that complicated right now. There are more to talk about on performance based, especially, but we'll leave that to another session. Now, let's take a look at these restricted stock awards and units. So, first of all, the restricted awards and units are generally awarded at no cost and do not have an exercise price. As holders receive shares at no cost, there is more income to be perceived by each underlying share. That has two implications. When we were dealing with the ISO session, I gave you an example where the exercise price is how much you pay for an asset. And the FMV on the grant date is how much that asset is actually worth. So if you are paying $5 for something that is actually worth $10, that $5 spread is the amount that the company is giving you as income. And that serves only for this this example. Let's not use this for expense accounting. I just want to explain what we're talking about when we are talking about ordinary income. Now, if you get an RSA or an RSU that you don't need to pay an exercise price for that, that means that you paid $0. So that whole amount will be ordinary income. That has a tax implication because that whole amount will be taxed. However, you are not paying for the exercise price itself, which should be more expensive than paying the taxes for it. You are only paying the taxes and not paying the price to purchase it. This has an effect on the dilution because let's imagine that a company is hiring an executive and they want to offer her $100,000 in stock awards value. If you imagine that this person will have to pay for an option, so they are getting the option to purchase stock, but they will have to pay a price for it. They are getting the option for an underlying asset that, let's pretend, could be worth $10 in the future, but they will have to pay $5 for it regardless. That means that the value that's actually being given to that executive is $5. But if they are granting an RSA or an RSU, they are giving the full value, and that's why we call this a full value award, then we are granting $10. So you will need to issue half of the stock that you would need to issue for an option, and that's just an example for a simplification. That's not how we do this calculation. I just want you to understand that RSAs and RSUs offer more value. So if they offer more value, less units, less shares need to be issued to offer the same value to the employee or participant. This will cause less dilution, especially for private companies or closely held companies. You don't want to be giving ownership out without thinking about it, because you will be stuck with these people voting on decisions. Maybe you don't want them voting on some important decisions. Maybe you don't want them having that much ownership over your company. Maybe if you are issuing options and issuing more and more options, uh, you will end up having less than the 50% you would like to have over your company. There are lots of considerations to be made here, but it's important to think that one of the advantages of restricted stock awards and units for companies is that they are less dilutive. However, they come with a problem. When you are issuing RSAs and RSUs to employees, they have less control over their tax liabilities, because when you have an option, you can have the option to exercise it or not. You have the option to exercise it on the next year. So if you are on a specific tax bracket that you don't want to go over, you can decide to exercise your options on the next year and have the tax obligations transferred to another year, something like that. But you do not have that option with RSAs and RSUs because you do not have an exercise price. They will simply vest. You will simply have to pay your tax obligations regardless of what happens, except if an 83 election is made and we have 83B and 83I, but we'll talk about that on another session. So, the restricted stock awards and units, we have talked about their differences against the options, but we have not yet talked in depth about the differences between one and the other. Now, let's talk about these differences. The issuance of shares on restricted stock awards and units is the first one, and I mentioned it en passant in a few slides earlier. So, RSAs have shares being issued at grant. That means that if a company grants you 10,000 RSAs to vest over 4 years, even though the restrictive conditions will be waived over these 4 years, what you have right now is stock, is shares. And for that reason, you will usually get voting rights, you will usually get dividends, just as if you actually had shares. Now, for RSUs, they are units, they are not shares at the moment of issuance. They become shares at the moment of release. And the release is generally at the vest date, but it may not be. The release is exactly the process that is made by the company to make your restricted stock units be no longer restricted and become stock, common stock, or whatever class of stock that you have underlying those RSUs. But it's basically the RSU becoming a share. This could happen at the vesting date, but it could happen after the vesting day up to a limit that we'll discuss later, or if you have an 83I election, this could also be deferred. We will talk about those later. Don't worry if I'm throwing in a term or a section or a legislation and I don't explain it right away. Just understand that this is something that is doing whatever I'm saying it is, and we will talk about that at a later moment, because here we are focused on building the foundation for you to learn about the taxation and the legal issues on these awards. Now, as RSUs are not shares until they are released, then they do not have voting rights. They should not have voting rights. They cannot have voting rights. However, for dividends, they may be eligible for dividend equivalence, which is not dividend, but it's like dividend. It's calculated as the dividend, except that it is paid at a later date. Now, and it should not be treated as dividend. Now, the tax obligations. Now, for the RSA, the tax obligation generally comes at vesting. So, when you vest your RSAs, you will have ordinary income recognized, and the ordinary income that will be recognized will be equal to the FMV on the date of vest, because you have not paid an exercise price, so that whole amount is ordinary income. But why is there an exception to that? Remember that I talked about the 83B and 83I? If you have an RSA, you have up to 30 days to make an 83B election. When you make an 83B election, you are choosing to pay your tax obligations up front. And in those cases, then the ordinary income will be measured on the date of grant and not at vest, but usually at vest. If nothing says otherwise, you will consider this to be taxed at vest, and the taxable income will be equal to the FMV on the date of vesting. Okay, so what about the RSUs? They are generally taxed at release, but they could be taxed before that, because just as we have the option to pay the tax obligations up front for RSAs, we have the option to defer the release of our RSUs to a later date. There are rules to that we'll discuss in another moment, but this is possible. And even so, we have yet another thing to consider: FICA and FUTA taxes. FICA and FUTA taxes, they are due as soon as the award is no longer subject to a substantial risk of forfeiture. So, as soon as you have fulfilled the conditions necessary to vest that award, it doesn't matter what, those taxes will be due. Now, one case that the CP exam likes a lot is the retirement eligibility. If your award has a provision that when you retire, all options are vested, then as soon as you become eligible for retirement, your awards are no longer subject to a substantial risk of forfeiture, because at any time you could choose to retire. You are no longer subject to the risk of being terminated at any time or terminating, because you can just choose to retire. So the risk of forfeiture is no longer substantial. It's very, very low. So at that moment, then there are FICA and FUTA obligations to be covered. Now, I hope you found this session useful to you. There is a lot more to discuss on restricted stock awards and units, but we will cover those over the future sessions. We are going to talk in depth about the tax implications, how to calculate taxes for ISOs on a qualifying and disqualifying disposition, some SEC filing requirements, everything that you need to know for the CP level 1 exam. We will cover on these CP study sessions. So I hope you subscribe to Akawan Equity Management channel. You leave us a comment if you have any questions. Leave us, click on the like button, the bell button, and send us a message on LinkedIn. And feel free to add me as a contact on LinkedIn as well. It's always a pleasure to help people trying to learn more about equity compensation. Have a good one.